Welcome to this video, guys, and today I'm going to explain the exact economic cycle that will allow you to understand all the markets as a whole, whether it's the commodity markets, the forex markets, the stock markets, the cryptocurrency market, the futures markets. It doesn't matter. You will be able to understand how these markets work thanks to the economic cycle, which is cyclical. And to understand this economic cycle, you will need to understand the intervention of central banks. Depending on how the central banks intervene, we will have markets that will either go very, very high or very, very low. And to understand when markets are going to rise drastically and when they are going to fall drastically, we need to understand the intervention of central banks, knowing that their intervention will implement monetary policies over months and months. So what you need to know is that the goal of a central bank is to maintain inflation at 2 to 3%. If this inflation is not maintained at 2 to 3%, then either the central banks will be forced to intervene in a context where inflation is too low, and thus we will have to stimulate the country's growth, or they will intervene because inflation is too high, and we will have to slow down the country's growth. So what you need to know, if we start from the left, is that if we have very high inflation, the central bank will have to intervene with an interest rate policy. For what purpose? For the sole purpose of burning money, all right? Because there is way too much money in circulation, so citizens suffer from inflation, businesses suffer from inflation, and as a result, growth is no longer good at all. So it is absolutely necessary to reduce this inflation. We implement an interest rate policy called quantitative tightening, whose sole purpose is to reduce the money supply to lower inflation. What is going to happen at the level of the banks? Well, the central banks will sell their bank bonds to commercial banks, which will buy them back. When commercial banks have bought back bank bonds from the central banks, they will have lost liquidity. And since they have lost liquidity, their interest rates will increase. That means citizens will be able to borrow less, right? As a result, they will invest much less because interest rates are too high and the cost of living is very significant. This has a very negative consequence on businesses because they make less profit. There is less growth, there is less stimulation in the economy, so growth and consumption have decreased. A very bad thing. Unemployment is coming, they are forced to lay off, and since they are laying off many employees, we will have an NFP, the economic news on the financial markets that interests us, which will be negative. This negative unemployment will also not benefit the stock markets, simply because investors will see risk during this period. What are they going to do? They are going to withdraw their liquidity from the stock markets and instead buy government bonds, which are much safer and will yield much more interesting returns during that period. The overall assessment is that growth has slowed and the currency has regained value. Now, there can be a problem during this period, which is that the money supply is so large that the central banks can no longer regulate inflation to 2 to 3%. So we are going to return to an economic cycle that is, after all, cyclical, and the central banks will have to intervene in the market again with interest rates. What you need to understand, and the summary of this first part before we move on to the charts and I explain it to you in more detail, is that there is a relationship between three economic news items: interest rates, inflation, and the NFP. If we are in an interest rate policy, meaning that inflation is too high, then you know that you will have significant interest rates, so everything actually stems from the inflationary context. Do we have a lot of inflation or not much inflation? If you have too much inflation, meaning inflation is bad, the inflation numbers are not good, you know that interest rates are going to increase. And if interest rates increase, you already know that the NFP is negative, because when interest rates go up, it means we have an inflationary context, and when there is inflation, companies are forced to lay off employees. On the other hand, in the opposite case, when you have low inflation and the economy, where central banks inject a lot of liquidity, well, you will have extremely low unemployment, meaning there will be a lot of hiring and the market will be doing very well. And it all starts again from this correlation, that is, low interest rates. If interest rates are low, it means that inflation is low, and the consequence of low inflation is very good unemployment. So by understanding these three things, you understand how the economic cycle starts to work. The only thing you need to know is that the central bank's objective is to maintain inflation at 2 to 3% and achieve moderate growth. We will move on to the charts, and I will show you this in a bit more detail to understand how we can interpret this economic cycle graphically. And I will start with something not very complicated. So now you will go to the chart. In 4 hours, you have the XOUSD, and you can look at November 4, and you realize that there is an NFP that drops. This NFP previously dropped to 315. It was expected at 200 and finally dropped to 261. What does that mean? It means there is a lot of unemployment, right? There is more unemployment than expected. And so when there is a lot of unemployment, right? When the NFP is high. But what does that fundamentally mean? Well, fundamentally, it means that investors are scared. Investors do not like unemployment. It means that the stock market is going to decrease drastically. And if the stock markets decrease, what will happen? Well, the commodity markets like gold, which is a safe haven, will increase. That's what needs to be understood. We're going to have a market that will certainly increase. So we're going to try to see if we can acquire lots, so that we can position ourselves. Here you see that we are recovering. Market lots, and thanks to your market structure, you know that we will gradually start to rise again and aim for higher highs. So our first target, if you haven't yet watched the previous videos to understand market structure and the liquidity cycle, go watch them. Here you are in a pullback, okay? That means the market has made an impulse and here you are making a pullback. This pullback here, retraced from this point. So the pullback is validated simply because it recovered liquidity, alright? We recovered one lot, we recovered two lots. We arrive at this zone, and you see that in this zone we start to create bullish structure again. One break, two breaks. You have the liquidity grab, you react in the order block here, you even liquidate this order block, so that means it is very important. And you simply show us that we have recovered some liquidity. We have an NFP that will be released here. This NFP, we already have the results since we have a replay. And when the result comes in, we see that we have an NFP that is much more anticipated than expected, which comes in much stronger. What does that mean? It means that investors will put their money into gold, and therefore we will have a rather bullish gold market. So you need to start asking questions. To ask yourself if your market structure allows you to buy. Yes, if your market structure allows you to buy, and you take some profits once the highs are broken. The next news is inflation. So core inflation is just inflation without taking into account commodity markets and energy prices because they are very volatile and are not considered. On the other hand, inflation without the core is inflation taking everything into account. And here it's the same. You see that we actually have decreasing inflation, but it remains very high. You see that we are not experiencing a very significant decrease either. We have 8.2, 8.7, 6.6, 6.5, 6.3. So we have 6 repeated. We don't really have a very significant decrease. We have unemployment that is bad. And if we have unemployment that is bad and inflation that isn't decreasing, it means that interest rates are not having an effect. So if the interest rates don't necessarily have an effect, well, we will look at when the next interest rates are, because that means he will certainly raise these interest rates. And by raising these interest rates, well, quite simply, we have the FOMC minutes here, the interest. Here we have Powell speaking, so we have the upcoming rates, and we will look very closely at the FOMC minutes right here. Let's make a note of it, so we don't forget. This means that we have a market that is generally going to be bullish because we have bullish structures that allow us to take positions in the market in a bullish manner. So now let's take a look at what's happening. You see that we have a market that is literally exploding upwards, simply because, by the way, let's look at how the CPI, the inflation, came out. Oh yes, we saw how the inflation came out. It didn't really come out very well. We didn't see much improvement. And now you see that we have a small retracement and we are rebalancing. Look right here. We are rebalancing, certainly to create new highs. So it could be very interesting to play this rise here. You see that the market is really rebalancing. So we have the FOMC minutes that just came out right here. And in the FOMC minutes, what happened? We don't have the FOMC minute results yet, but I think we have a rate hike. Anyway, we'll check that right after. And if you notice that we have a buying setup and once again, we're making a pullback, gathering liquidity and likely pushing the market upwards, well, you're starting to understand everything and you'll need to handle it in the best possible way. The most important thing to understand was that here we came to price the NFP, and here we have a CPY that continued, an inflation that has not drastically decreased, which means that the interest rates are not having an effect. If the interest rates do not take effect, we will raise the interest rates again. So, how do you increase the interest rate curve? You go to a one-day chart. On the one-day chart, you then select a small plus sign right here, and you will mark Usinter, and you will be able to add this curve to your chart. By adding this curve to your chart, you will notice the interest rate curve. So here you see that the interest rate curve has been raised everywhere here. So we must have raised the rates on this date, I think. Let's check. We looked. And yes, here we raised the rates at the Fed on November 2nd. So on November 2nd, the rates were raised. Very interesting indeed. Look here. So right here, we had interest rates that were raised. We don't have the results, but there you go. You have interest rates that were raised. In fact, the fact that these rates are being raised, well, what does that mean? It means that it will be very interesting to invest in a market with high rates. And so, this is the beginning of the rate hike. And since we have investors who are afraid of the stock market, well, they put their liquidity into gold. And if we look a little closer at gold, well, we realize that gold is literally at extraordinary levels for buying it back, right? We really have extraordinary levels. The conclusion and final word of this video is to tell you that you absolutely need to associate this economic cycle with your market structures. Because without understanding your market structures, you won't necessarily understand the economic cycle graphically. The economic cycle graphically retrieves precise levels of structure, precise levels of liquidity. It is absolutely essential to understand the liquidity cycle. So if you haven't seen the previous video on the liquidity cycle, go watch it right now. I have put it in the description to make it easier for you so you can understand graphically how it works. Once again, I am not a charlatan like many people on YouTube who tell you nonsense. I actually make money from the financial market. You can now connect to my PayPal and I guarantee you will see I generated a little over $115,000 just on my broker last year. There is no problem, I will show you everything transparently. I will show you how we organize during the editing process. Here, I opened PayPal and we are going to log in live. I will just blur out my first and last name. So here, we arrive at PayPal and as you can see right here, there is an initial transfer of 34,000 euros. This is the last withdrawal I made from Interactive Broker, but last year in total, I withdrew more than 151,000 euros. I hope that what I am showing you here gives you belief and shows you that it is possible to achieve and that you don't fall into the crowd of people who scam you, who tell you nonsense, and that you will truly be able to gain value. But here it is, I really want to bring you different things, another perspective with a lot of objectivity in my words, in my statements, and I hope you feel it. If you enjoy this kind of video, subscribe massively to the YouTube channel and leave me as many comments as possible in the description. This was Clark, see you very soon. Until next time.